All right, let's dive right into this. You know, over the recent Christmas holiday, while many of us were unwrapping presents and spending time with family, something really unusual and potentially explosive was happening in the world of silver. Today, we're going to unpack what one source is calling a historic holiday mismatch. And it all really boils down to this one simple question. When the big financial hubs in the West, London and New York, shut down for a few days, what happens to something that's traded all over the world around the clock? Well, as we're about to see, a whole lot can happen. And boom, this slide gets right to the heart of the mystery. Take a look at these numbers. On Christmas Eve, the Western COMEX exchange closed up shop with silver sitting at $71.84. But over in Shanghai, where they were still trading, the price was way up at $78.49. I mean, that is a huge gap, and it just begs the question, how on earth do those two prices ever meet in the middle again? So here's our game plan for today. First, we'll look at exactly why this mismatch happened. Then we'll dig into the powerful forces that are pushing on the price of silver. After that, we'll cover China's absolutely critical role in all this, an analyst's pretty bold prediction. And we'll wrap it all up with the big, final question this whole situation leaves us with. Okay, first things first, let's talk about the nuts and bolts here. How can a price cap like this even open up in our modern, super connected world? Well, it really just comes down to who's open for business and who isn't. This timeline really shows you the core of the issue. The COMEX in New York closed early on the 24th, and then both it and the LBMA in London were completely closed for Christmas Day. London was even closed the day after for Boxing Day, but, and this is the key, the exchanges in Shanghai, they were open and trading the entire time. This created this very unique window where pretty much all the price discovery for silver, for the entire world, was happening in one place, the East. And that simple difference in holiday schedules led to this. A stunning $6.65 gap for every single ounce of silver. Now, this isn't just a small blip on the radar. The source we're looking at calls this a major significant break in the global market. So what was pushing that price up so high in Shanghai? It didn't happen in a vacuum, that's for sure. As we're about to see, the source points to some really powerful global forces putting immense, and I mean immense, pressure on the price of silver right now. The source material really zeroes in on four big drivers. First, you've got this explosion in industrial demand. Second, all the geopolitical tension and instability out there is causing a flight to safety. Third, we have record-shattering levels of global debt. And last but not least, you have major players, we're talking central banks and even billionaires, buying up physical silver. Let's just zoom in on that industrial demand for a second. Silver isn't just for jewelry anymore. It is an absolutely critical ingredient in so many of our fastest growing technologies. I mean, think about it. Solar panels, electric cars, 5G networks, artificial intelligence, semiconductors, our modern world is literally being built with silver. And this quote from an analyst in the source, wow, it really captures just how desperate things are getting. It suggests that these huge industrial users are getting to a point where the price doesn't even matter anymore. They just need the physical metal to keep the assembly lines from grinding to a halt, and they're willing to pay whatever it takes to get it. And it's not just giant corporations either. The source points out that some very wealthy individuals are making big moves. It cites the U.S. billionaire investor David Bateman, who has reportedly stacked up over 12.5 million troy ounces of silver. Just to put that into perspective for you, that one private stockpile is about 1.5% of the entire world's annual supply. And hey, if you're finding this interesting, we'd really appreciate it if you'd like, share, and subscribe to follow us. That way you won't miss any of our exciting updates. Okay, now let's talk about what could be the biggest piece of this entire puzzle. China's absolutely commanding position in the global silver market. This chart really shows you just how big of a player China is. The country mines about 15% of the world's silver, which is a lot. But look at this other bar, refining. That's the process of turning the raw metal into the pure silver everyone needs. China refines a staggering 40% of the entire world's supply. That gives them enormous leverage over the final product that actually hits the global market. Now here's the real kicker. The source says that brand new export restrictions are scheduled to kick in over in China on January 1st, 2026. These new rules are going to require a very strict license for any silver to leave the country. Some analysts are going so far as to call this a near ban on exports, and they're worried it's a move to keep all that refined silver inside China for its own hungry industries. So, let's recap. You've got Western markets close for the holidays, you've got massive demand pressure from all sides, and you have the single biggest player about to seriously restrict supply. Well, this all leads us to the final part of our analysis, the source's prediction for what could happen when those Western traders finally get back to their desks. The source basically lays out a potential domino effect. It starts with Asia continuing to bid the price higher and higher, which physically pulls silver out of Western vaults and sends it east. This starts to drain the inventories at places like the COMEX. That pressure could then force short sellers, those are the folks betting the price will go down, to rush in and buy silver to cover their bets. That sudden rush could cause prices to gap up violently the moment Western markets reopen. In a worst-case scenario, the source speculates the exchange could even risk a default, where it might not have the physical metal to deliver on its promises. Now, it is really important to say that the exchanges aren't just going to sit there and let the market fly off the handle. The source points out that they have tools in their toolbox to manage a crisis. They can halt trading for a cooling-off period. They can even declare what's called force majeure. That's basically a legal escape clause that lets them delay deliveries. They can also change the rules of the game on the fly or jack up margin requirements to make it too expensive to gamble. These are all levers they could pull to try and regain control. And all of this brings us right back to where we started. We have what one analyst has called a historic holiday mismatch, where one side of the world is setting a price while the other side is on vacation. And it leaves us with the most important question of all. When everybody is finally back at the trading desk, will the price in the West be forced to play a violent game of catch-up with the price already set in the East? And what happens then?